Don Luskin, what really counts is this rip-roaring stock market of ours, which extended big time into NASDAQ this week. Computers and telcos and SOX and Cisco and the whole 9 yards. Talk to me about this big stock market run.
Well, March 17th, Bear Stearns Monday was definitely the bottom for stocks, no question about it. That's when the market started to discount the restoration of confidence. It was going to pull the economy out of the fear-induced slowdown that began last November or December. We're not going into recession. We haven't been in recession, and we're going to pull out of it. It's very hard to find any economic statistics that are at recessionary levels. We've been in a mere slowdown, a shallow one, and we're coming out of it.
Employment, definitely, right?
Employment's not recessionary levels. Not even close.
No. Wait,
in fact, Jared, I want to go on record as saying, you're talking about nominal wages and salaries.
No, I'm talking about...
And then when Jerry changed the field to talking about disposable personal income, all of a sudden you switched to real.
No.
You're very good at cherry picking the negative numbers. Nominal personal disposable income was up at a 1.8% annual rate in the month of April on a per capita basis, and up 2.7% overall.
Any knowledge of what payrolls have done over the past 4 months, Don? Let me hear it. Yes or no? What have payrolls done over the past 4 months?
Payrolls have fallen by 80,000, 80,000, 80,000, and 20,000.
Let me ask you this, Don.
You ask me a question, I'm going to answer it. You're just going to have to hold your tongue for a second. Now, typically, when you're 4 or 5 months into a recession, you're losing 250, 300,000 payrolls every month. This ain't a recession, baby, and it doesn't matter what the union bosses on your board of directors that pay your salary say. We are not in a recession. Period.
And by the way, can I ask you a money chart? The federal funds rate is now expected to be raised by Bernanke and Company in October. Let's put the futures market up for the Fed funds rate. There's about a 50 or 55% chance that we're going to see we don't have it. So I'll just take my word for it.
I do.
It's about 55% chance that the Fed is going to tighten up. The Fed is getting concerned about the dollar. That's good. They are concerned about commodities. That's good. They are concerned about inflation. That's good. So, Don Luskin, what does this mean? They rise in Treasury rates and the potential rise of the Fed funds rate. Is that bullish or bearish for stocks? That's where I really want to go here.
I think the idea here is that the thing that is going to make the Fed raise rates is that the economy is recovering, and that's good for stocks. So when the Fed raises rates, the fact that they raised rates won't be bad for stocks because they wouldn't have raised them in the first place if it weren't for something else, the recovering economy, that was good for stocks.
Don, can I ask you?
Can I ask you a follow-up? Hold on a second. Don, look at these numbers this week. This is so important. The NASDAQ was the really big winner. It was up 4.6%. In May. That's a huge number. Now,
well, in fact, Larry, everyone's talking about energy stocks, but from the March bottom, tech is up as much as the energy sector.
That's correct. And tech is a classic growth area.
You bet.
Tech's a classic economic recovery area. All right, Don. Computers this week up 4.5%, led by Dell, which had very good earnings. We're also seeing it in the Cisco-type communication stocks. We're also seeing it in the software stocks. We're also seeing it in the SOX index. We're also seeing it in the telephone companies. I don't know where that's coming from. What's your tech take? Because I think this is really a key part of the stock market's evolution towards Goldilocks.
Well, this is one of those times where you have to be very discriminating when you talk about the economy, because the economy includes things that are an outright depression like housing, and it includes things that are an outright boom like technology. So, for instance, high-tech industrial production is at all-time highs and going at roaring growth rates, even as overall industrial production is flattened out a little bit in this slowdown. So it is, just as people say it's not a stock market, it's a market of stocks, it's not an economy. It's a portfolio of microeconomies, and the smart investor looks at these sectors one at a time and figures out the winners and the losers and steps aside from some of this falsely macro analysis where you try to make one size fits all. We are in a diversified situation.
All right, so Pinto, you don't agree. Don Luskin, bull or bear on the stock market?
Bull.
Same. Don Luskin, you really helped create this whole new paradigm with gold falling and real interest rates rising. I think it's playing out exactly right, Don.
It is. And you know what? The Fed is definitely going to be raising rates by October. I think by the end of the year, you're going to see rates at least at 3%.
So oil is destined to come down. If the dollar goes up and real interest rates go up, Don, oil's, I don't know, it's going to go to 100, maybe less than 100.
Yeah, you know what? It's so volatile right now, it could easily go to 100 just on noise. But don't forget, the world economy is coming out of recession expectations, and that means that people are going to be expecting more oil consumption in the future than maybe they were thinking about 6 months ago. So, there's a demand phenomenon here. It's good.
All right.